Good afternoon, everyone, and welcome to Stock Market Today by Investors Business Daily. It's Justin Nielsen here, and I'm joined by Ed Carson. It's February 18th, 2022. We are heading into a long weekend. Monday is a day off, so you can show up here, but we're not going to be here. Ed, let's get right into it. I mean, it wasn't it wasn't a great day. Seems like that's a recurring theme that we've had a lot this year. S&P 500 down 0.7%. NASDAQ Composite down 1.2%, Dow Jones Industrials down 0.7%, and the Russell 2000 down almost 1%, 0.9%. So a lot of destruction there. You look at the sectors. Not really any place that was safe. Everything pretty much got hit. You had some of the consumer staples up a little bit. A lot of destruction. We'll take a look at CMC again today, commercial metals, Union Pacific, rail, and also Dollar Tree, which was kind of showing a breakout. So let's start with the markets, though. With all that destruction going on, what is your take? What are we to make of this?
The market is not acting well. I mean, and the NASDAQ hasn't been acting well all the way almost for 2 months now.
Yeah.
Obviously, especially in 2022. Look, a few days ago, we were getting up toward the top of this little range, and hey, we were starting to think maybe. And then ever since then, really hasn't been too much. I mean, oh, remember this day? I remember this day. It's like, it was pretty meaningless even at the time. And now it really looks clear. The market has undercut the NASDAQ and S&P have undercut the low of their follow through days, which is January 31st. They're heading pretty low here. They're getting, they're sort of moving toward now this January 24th, though there's still a little bit of distance left, but, it's starting to get closer to this than to even get up to their February highs, let alone something better.
Yeah. And it certainly seems like this is an area where we could just see more of this back and forth action. In fact, one of the things that we were saying on IBD Live, a lot of folks were suggesting, hey, look, these pockets of strength that you see, these rallies, this might be a good time to get out of some of your stocks, take that opportunity to sell into that strength and maybe get out before another leg down. That's not to say that we can't bounce here, but it certainly could go lower too. It just feels like, how do you have an edge?
Yeah, I don't see how you can have an edge or any confidence. Certainly not unless you have like sustained strength, getting above a lot of key levels before you start feeling really confident in the market again. And just, yeah, look, it's been so headline driven and headlines that you can't even trust the headlines. Where, I mean, what does it mean? And the headline, it might be truthful, but it can be refuted or, responded, or something else could overtake it. It was a long weekend. So, I mean, technically it wouldn't shock us, to see a bounce here. I mean, for whatever, as you say, whatever that's worth. There could be a lot of news over the weekend. Maybe we'll see a big bounce or big drop Tuesday morning. I don't know, maybe nothing. So there's no edge. It's just better to, rather than try to make guesses about what the market might do, is just to try to stay out of it as much as possible.
And I just want to make one clarifying point right here. I'm looking at the chart that you have up of the NASDAQ Composite, and it looks like, oh, well, is this an area where it would be potentially get support here? That's a moving average of the relative strength line. So that's not a moving average line that is related to price at all. So, again, that just kind of shows how weak the NASDAQ Composite has been versus the S&P 500. That's what that relative strength line is showing. And that orange moving average is just a moving average for that relative strength line, which actually has no scale, I guess. It's not like
it's not tied to it at all. Right. It's completely irrelevant to the indexes. Sorry about that.
Don't think. I just want to make sure people don't think, hey, we could get a bounce right here.
Looks like it. Looks like it does. Look at this. Look at. Looks like it's relevant, but it's not. It's not.
Yeah, that's coincidence. Now, one other thing I just want to address is, one of the moving average, or a couple of the moving averages that people do take a look at, is the 50-day moving average line crossing below the 200-day moving average line, what's known as the death cross. Is that something we should be looking at and making any, I guess, predictions based on that?
It's not a positive sign when the trend over the last 50 days is worse than this. I mean, that's what it's saying, just how bad over 50 days, not just short term, not just 10 days, 21 days. It's really bad over this whole time. But be honest, if it's the death cross, you should be out. You should be out. If you should have taken the turn before getting to this crossroads.
Mhm.
It's a really negative signal. We talk about the market doing well when the NASDAQ is above the 21-day line and the 50-day line, and those index, we're nowhere close to that. And all the technical measures are negative right now.
Yeah, I would say that's my biggest problem with the death cross or even the golden cross is they just, to me, tend to be late. We have such earlier signals that a lot of times by the time that happens, it's like, oh, well, yeah, of course I was out. Why would I have wanted to be in at this point? Let's go ahead and take a look at the S&P 500. Again, it's not like it's a very different story there, even though it's had some help from some of the energy names and things like that. There's still a lot of destruction happening here, trading below the 200-day moving average line. You can see that orange line is very flat on the relative strength, there. So, the S&P 500, no big surprise, it actually matches itself.
Yeah, it's been able to keep up.
Right, it's been able to keep up. But anything to add on the S&P 500 here?
The only thing is that with the 50-day line and 200-day line, it just puts in stark relief the resistance levels kind of thing. I mean, the 50-day line is now pretty much even with these highs. This came above the 200-day line, went right back below it. But, there's just the same situation.
Now, the Russell 2000, for a little while, it looked like, there was some hope. It was like, oh, is the small caps going to lead something? Is that kind of telling you that there's more of a risk on and things are going to come back? And again, it seemed like it was a false hope because here, it's not gaining any traction either. Maybe it doesn't look as weak as it did before, but it doesn't look strong either.
Yeah, and you look at the volume too. It's like all the red days, much higher volume than the encouraging days. Yeah, there was a little sign that maybe that the market breadth was improving a little bit. Not that it was like hooray, but at least that, for so many months, and you can see how bad the Russell has been on the weekly, and it's basically trading it, went nowhere last year. It's around 52-week lows. So any kind of sign, the broader market was weaker than those mega caps. So it was nice to see some strength, but even then, it really wasn't much. It's, fading off again. There just isn't much to cling to. There's a few sectors that are doing well. Those sectors, some of those sectors could reverse pretty negatively if we have good news about Russia, Ukraine, some of the
Right.
oil and the fertilizer. So even there, you have to watch out. But aside from those pockets of strength, not much is working. And, big caps, small caps, what have you.
Yeah. And just speaking of the breadth, if we take a look at GMIAB, which is the NASDAQ, a number of indicators, specifically the NASDAQ advanced decline line, the breadth was really kind of in this major downtrend for a long time. So it's not like it's gotten much worse, but it's not like it's gotten much better either.
Yeah, there was just that little bit of hope that maybe something's improving. Okay. But we've seen that before. There have been moments where there's been a little bit of breadth improvement and it just hasn't lasted. It's like with everything else, you can't just a day or two, especially now, a day or two of good news, whether it's market breadth or the indexes, that's just not enough. That's just not enough. We need a lot of strength. The market rally, it hasn't failed yet. It's still under pressure, at least last time I checked. But it's almost to the point where you need to see really real confirmation that that this rally has some strength.
Yeah. One more indicator we can look at on IBD Live today, we had Matt Caruso on, and he often will take a look at, where are you at with your new highs versus your new lows? And one other indicator that we do have on MarketSmith is if you go to NASDQ, this has a number of daily market indicators, and at the bottom there you have a 10-day moving average of the new highs versus the new lows, and you can see the pink line, that's the new lows. That's just been really dominating since the end of November, really, when the Omicron news came out, that after that Thanksgiving holiday. It seems like that's really where the breadth the breadth got worse, the new highs got worse than the new lows, and it's pretty much stayed there since.
Yeah, I mean, it's going to be really hard for new highs. It's almost like the power trend. If he wants to see new highs beat new lows, well, the market's going to have to be pretty close to new highs. I mean, that's what it comes down to.
Yeah.
I mean, we have a couple of good days. Yeah, a few stocks will hit new highs, but I mean, not many. So it's almost like you need the market to be above the 50-day line, above the 21-day line. And guess what? Then you're going to start seeing that new highs outpacing the new lows. So a lot of the indicators, whether you use this one or that one, they're going to show ultimately the similar type of situation. Are we, is the market and our leading stocks showing strength? And this is just another indication. The answer is no, it is not.
Well, let's go ahead and take a look at some of the stocks that are holding up maybe a little bit better than the others. And we can start with CMC, which is Commercial Metals. This is a stock that is, again, it's basing, it's above its 50-day moving average line, looks very different from the market. This chart maybe looks a little bit more volatile if you kind of switch to the weekly, which gives you a logarithmic view. You can kind of see that this is one that doesn't move too much, but what's your take on this one?
Yeah, I like the fact in some ways that it's not quite as volatile as some of the other steelmakers. I'm not saying that it can't have some big swings, don't get me wrong, but it just hasn't had quite the same gyrations. 4 straight weeks up. The relative strength line is surging into new highs and has been for a while. Arguably it's actionable now, in my opinion, because it's a little bit above the 50-day line, sort of clearing there. If you wanted to jump, got in there, but even better, maybe it forms a handle. There was some evidence that maybe it could form a handle here and clear this area, which would also be right around this. There's probably wouldn't be too many unhappy people. Almost everybody would be a winner if it got above that level. Probably could use it as an early entry. In this market, it's hard to get excited about any stock breaking out to new highs because they often get above their 10-week line a fair amount. To actually do that. But this is acting well, good earnings. Good earnings going to be in 2022. We'll see about 2023. A lot to like about this stock right now.
Mm-hmm. And another slower mover that is moving things across the country, Union Pacific, UNP is the ticker symbol on this one. Of course, this is in the rail area. Another one where we've got that relative strength line going into new highs. That's what that blue dot is signaling, that it's happening while the stock is basing. A lot of times when we see those stocks have relative strength lines and new highs before the price, that's kind of giving you an indicator. But we still do have this market overhang. So how is someone to look at, the idea of, hey, there's a bull market somewhere, you can always find a bull market somewhere, that idea with, but what about your chances? What about your odds? And what about the extra risk?
Yeah, there's not much. And what's your reward too?
Yeah.
How much will this move? Okay, this had a really good week this week, but over the last several weeks hasn't gone anywhere really. So it's hard to get excited about like taking on added risk because there could be bad news about the company or the sector, or the market could just really just tumble. And even if this doesn't fall as much, it would still probably fall. Like if the NASDAQ and the S&P fall another 10%, it's hard pressed to believe that Union Pacific is going to be charging higher on that. I will say it is an extremely shallow base. It is only 8% deep. So even if it did break out to a new high, it really wouldn't be that high above the 50-day line.
Right.
It's less than 2% above the 50-day line. So after all these other charts that we're looking at that are whippy and 30, 40, 50% deep, there are some advantage on this. So look, if the market shows some strength, starts showing strength, this might do well. But yeah, in this market, it's hard to see a whole lot of interest in buying much at all.
Yeah. And to your point, with that reduced risk, a lot of times you get reduced reward too. So, is it better to just kind of stay out completely rather than try and get a few pennies here and there on something? And let's go ahead and round the discussion out with Dollar Tree, DLTR. Now, a big move on Dollar Tree today, over 5%. We actually put this on Swing Trader, relative strength line and new high. There was some news driving this. What was going on?
Well, the chairman, who has been there for a long time, been chairman for several years, has been CEO, chief operating officer a long time, he's stepping down soon. Now, Mantle Ridge, an activist investor, took a big position, I think back in here, and then I think they initiated a board fight a few days later so that's ongoing. So maybe if this chairman is stepping down, that's a signal that Mantle Ridge will get what it wants or a lot of what it wants and shareholder returns. So a lot of move here. There is the issue. Obviously breakouts haven't been working too well, but what has? Early entries haven't been working too. Not much has. I think my concern here is that it's unlike the hotels or even the steel or some of those things. other discounters aren't doing well. Now,
Yeah.
maybe, I mean, this has already gotten a big gain from the whole activist news. And so that would be my concern, like how much more. I mean, I don't know the differences, and maybe they can unlock value, additionally, but looking at things like Dollar General or other stocks, anything, name it, they're not doing well. That's my only concern there. But
Mhm.
uh, there's a lot to like about what Dollar Tree is doing here.
Yeah, and to your point, that retail discount and variety group is 171 out of 197. So you always have to be careful when you've got what we call the lone wolf. Okay, is it truly doing something unique, or is it eventually going to succumb to the pressure that all of the others are succumbing to as well? So yeah, good analysis there. A lot of things to keep in mind. When you're doing any of the buying right now, when the conditions are poor, that there is that additional risk, the market pressure, the group pressure in a lot of cases, like with Dollar Tree, that can be weighing things down. So what else should investors be looking at? We've got a long weekend, as I mentioned at the outset. A lot can happen. I mean, we've got this very tense situation, between Russia, Ukraine, Russia separatists, all of this happening. A lot can happen over the weekend. What should we be prepared for on Tuesday? What kind of scenarios?
I mean, is it like you could have war, you could have peace. You could have just a whole bunch of confusion. I will say, look, January 20th is an interesting day, because that's when war games end between Russia and Belarus. That's one of the
Is
arguments
that
for why
February 20th?
February 20th. Did I say
Yeah.
what I know? But February 20th. So that's one of the reasons that Russia has justified having all these troops there.
Right.
It'll have less of a pretext for having them. I mean, they want to keep them there, they can. It's also when the Winter Olympics end. And why does that matter? Well, maybe Russia doesn't want to offend China by
Mhm.
having a war in the middle of, an Olympics and all that attention there. So
Mhm.
if you were to see that, but we'll see. I mean, anything could happen. And I also would say, like, look, even when this goes off the radar, there's still inflation, there's still supply chain woes. There's a lot of companies that were warning of supply chain woes. Maybe that's a convenient excuse, but that kind of situation, I just don't think like you can forget all about that. The market isn't looking good. If you didn't know anything about the news, the market isn't looking good. The news isn't, the stocks aren't looking good. I think you should just be thinking very defensively, just preparing for the next real strong market rather than trying to make something happen, on the short odds.
Right. And, to that end, you have to be very careful of these very short-term bounces. But what in your mind changes your thesis to say, hey, you know what? Now it's showing that it's getting traction. What kind of things are you looking at in terms of making you have a little bit more confidence in the market?
And look, as a bare minimum, I think the S&P getting over the 200 a day and the major indexes all getting above their 21-day lines. But that's just like, okay, we're not, we're stabilizing. It's not even
Yeah.
like strength. It's just not like we're on the verge of collapse kind of thing, not collapse, but, you know, um, but I really do think getting above those early February highs in the major indexes, convincingly, that would be saying, okay, we seem to be making progress here. And I think if we did that, we'd start seeing a lot of stocks, set up again. There's a lot of stocks that it's like, well, if you have a good week or two, then they start looking good. I think then you'd have more stocks. But there's a lot of those. There's a lot of this and this and this have to happen
Right.
just to have some confidence. And it really would just take one really bad day or maybe a couple of bad days, and we're at lows. And we could be, we could have another leg. This correction, we might say, really didn't stop. It just had a little pause, and now we're hitting another leg down.
Mm-hmm. Well, good analysis there. Thanks a lot for that, Ed. And that'll wrap it up for us this week. And hope you join us on IBD Live on Tuesday morning. We'll be right back at it 10 minutes before the open of the market, 6:20 Pacific time, 9:20 Eastern time. We have special guests. As I mentioned, we have Matt Caruso. So for those of you that haven't checked that out, you might want to go to investors.com/IBD Live, maybe get a free trial. Check out his really insightful answers to a lot of things. He was really sharing a lot of knowledge on different industries that he's taking a look at. Also, don't forget, we're going to be right back here on Stock Market Today. Ali will be back in the driver's seat on Tuesday. Hope everyone has a great long holiday weekend. We'll see you next time.